I have spent decades poring over the lessons of Benjamin Graham, the father of value investing, watching how his principles echo across time, from the chaos of the 1929 crash to the tremors of modern markets. Today, I want to walk you through one of the most fundamental dilemmas every defensive investor faces: the balance between stocks and bonds. Many investors, even those who consider themselves cautious, struggle with this decision. How much should you entrust to the unpredictable swings of the stock market? How much should you preserve in the steady, reliable embrace of bonds? This is not just a question of percentages. It is a question of temperament, discipline, and long-term vision. When Graham wrote The Intelligent Investor, he was already aware that human psychology was as much a factor in investing as numbers on a balance sheet. Fear and greed, hope and panic could undo the most carefully planned portfolio in a matter of weeks. Yet Graham offered a roadmap for the defensive investor, a way to navigate the storm without losing one's bearings, a way to participate in growth without courting ruin. Over the next 25 minutes, we will explore his timeless guidance. We will look back at the historical examples that shaped his thinking, from the crash of 1929 to the Great Depression, and draw parallels to today's markets where the same principles remain just as relevant. We will examine why defensive investors should resist the lure of speculation, why bonds are not boring but essential, and why a disciplined, thoughtful allocation between stocks and bonds can protect both your wealth and your peace of mind. By the end of this journey, you will understand the framework Graham built, not as a rigid formula, but as a philosophy, one that allows a defensive investor to build a portfolio that can endure decades, absorb shocks, and grow steadily over time. But before we dive into numbers and percentages, we need to understand what it truly means to be a defensive investor. And that begins with understanding the mindset Graham championed. To understand Graham's approach to stocks and bonds, we must first define what he meant by a defensive investor. Unlike the enterprising investor, who thrives on research, timing, and active management, the defensive investor seeks safety, stability, and long-term growth with minimal stress. The defensive investor is not someone who avoids the stock market entirely. Rather, they approach it with caution, discipline, and patience. They recognize that while stocks offer higher potential returns, they also carry greater risk, especially if one's emotions dictate decisions. Bonds, in contrast, offer stability, predictable income, and a buffer against the volatility of equities. Graham advised that a defensive investor should aim for a portfolio that balances these two worlds. He suggested that a reasonable split might be somewhere between 25% and 75% in stocks, with the remainder in bonds. The exact ratio is less important than the principle. Don't overreach during bullish periods, and don't panic during bearish ones. This is where psychology becomes critical. Many investors, even today, are tempted to chase returns during a market surge or flee entirely during a crash. Graham's defensive investor resists this urge. They understand that wealth is built gradually, not through speculative gambles, but through disciplined allocation, regular review, and a long-term perspective. Historical examples illustrate this vividly. During the 1929 crash, many investors who ignored the balance between risk and safety lost fortunes overnight. Those who maintained a prudent mix of bonds and stocks, however, were able to weather the storm, buy undervalued stocks at depressed prices, and recover more steadily in the 1930s.
In modern terms, think of a defensive investor as someone who owns a basket of high-quality stocks, perhaps blue-chip companies with consistent earnings, alongside government or high-grade corporate bonds. This combination reduces the likelihood of catastrophic loss while still participating in market growth. Understanding this mindset is essential before we move to the next segment, where we will explore how Graham quantified the relationship between stocks and bonds and why he insisted that flexibility, rather than rigidity, was the key to a conservative yet growth-oriented portfolio. The next step is to see how Graham's principles can be translated into actionable percentages that stand the test of both history and modern market volatility. Benjamin Graham often emphasized that history is the investor's greatest teacher. To understand the stock-bond dilemma, he urged his readers to study past market cycles and observe how different allocations fared during periods of prosperity and crisis. Consider the 1920s, a decade of unprecedented stock market growth. Investors who allocated heavily to equities enjoyed staggering gains, often doubling or tripling their portfolios in a few years. But the crash of 1929 and the ensuing Great Depression taught a brutal lesson. High exposure to stocks without a defensive cushion could wipe out years of wealth overnight. Bonds, by contrast, maintained their value and provided much-needed income during this period. Graham's analysis of historical returns led him to a simple but profound conclusion. There is no universally correct ratio of stocks and bonds. Instead, investors should adopt a flexible approach. During times of high market valuation, a defensive tilt toward bonds makes sense. When stock prices fall to attractive levels relative to intrinsic value, equities can be gradually increased. This principle is timeless. Think of the 2008 financial crisis. Many investors learned the hard way that portfolios overly weighted in stocks suffered dramatic losses. Those with balanced allocations of bonds and high-quality equities recovered more steadily. Graham's advice, though formulated decades earlier, perfectly predicted the value of such prudence. He also highlighted the importance of quality in both asset classes. Not all stocks or bonds are created equal. Defensive investors should focus on stocks of well-established companies with stable earnings and strong balance sheets. Bonds, too, should be of high credit quality, government securities or top-rated corporate bonds that offer safety and reliability. Furthermore, Graham stressed the importance of not overreacting to market swings. When stocks decline, defensive investors should avoid panic selling. When bond yields fluctuate, they should resist chasing the highest yields at the expense of safety. The goal is not to maximize short-term gains, but to protect capital and achieve reasonable, consistent growth over the long term. By studying history and combining allocation discipline with careful selection, the defensive investor can navigate the market's uncertainties. In the next segment, we'll examine how Graham quantified these principles into practical, actionable guidelines that any conservative investor could follow. Benjamin Graham provided clear, practical guidance for defensive investors on how to balance their portfolios between stocks and bonds. Unlike many modern advisors who offer rigid formulas, Graham emphasized flexibility, adaptability, and adherence to safety first. His core idea was simple. The defensive investor should never place all their faith in one asset class, no matter how appealing short-term returns might seem. He proposed a stock-to-bond allocation that could fluctuate within a defined range. Specifically, he suggested that stocks should comprise no less than 25% and no more than 75% of a defensive portfolio. Bonds would fill the remaining portion. The exact percentage within this range would depend on market conditions, personal risk tolerance, and valuation levels. For example, when stock prices were extremely high relative to intrinsic value, the defensive investor would lean toward the lower end of the stock allocation. Conversely, when equities were attractively priced, increasing the stock portion made sense.
Graham also highlighted the importance of maintaining this balance through periodic rebalancing. If the market's volatility caused the portfolio's composition to drift, for instance, if stocks soared to 80% of the portfolio, the defensive investor would gradually sell equities and buy bonds to return to the desired range. This disciplined approach, he argued, avoided emotional reactions and preserved capital over the long run. Moreover, he emphasized quality within both asset classes. For stocks, the defensive investor should select well-established companies with a long record of profitability, dividends, and financial stability. Graham often cited examples from his era, companies like General Electric and AT&T, which had survived multiple market cycles, maintained consistent earnings, and demonstrated resilience even in times of economic stress. For bonds, he recommended government or high-grade corporate bonds. He warned against chasing higher yields by taking on unnecessary risk with lower-rated debt. The purpose of bonds in a defensive portfolio was twofold: to provide a predictable income stream and to offer a stabilizing force when stocks became volatile. Importantly, Graham did not prescribe a one-size-fits-all formula. He encouraged defensive investors to use judgment and adjust allocations prudently. In his words, the defensive investor must be content with moderate returns which are earned safely, rather than chasing high returns with high risk. This principle remains as relevant today as it was in the 1940s. He also discussed the psychological benefits of a balanced portfolio. When markets plunge, the defensive investor is less likely to panic because bonds provide a buffer. When markets surge, they still participate in stock gains without feeling the stress of overexposure. The careful balance between stocks and bonds, Graham argued, was a form of emotional insurance as much as financial protection. Next, we will explore how Graham advised defensive investors to select individual stocks and bonds, providing concrete criteria that make this allocation strategy actionable rather than theoretical. Benjamin Graham believed that allocation alone was not enough. The defensive investor also had to exercise careful selection within both asset classes. Simply spreading money between stocks and bonds was safe in principle, but without attention to quality, even a balanced portfolio could falter. For stocks, Graham emphasized three primary criteria for the defensive investor: financial strength, earning stability, and dividend record. He advised selecting companies with a long history of paying dividends, ideally consistently for at least the past 20 years. Dividends, he argued, were tangible proof of a company's ability to generate and return profits to shareholders, providing both income and a measure of safety. He also encouraged evaluating earnings stability. In his era, many companies had faced volatile cycles, especially around the Great Depression. A company with consistent earnings through multiple economic downturns demonstrated resilience and management competence. Graham often used the example of large industrial companies that maintained profitability during the 1929 crash and the 1930s recession. Their stability offered reassurance to defensive investors who prioritized capital preservation over speculative gains. Financial strength was another crucial filter. Graham advised examining the balance sheet for conservative debt levels, ample working capital, and a strong asset base. Companies that were over-leveraged or reliant on short-term financing were more vulnerable to economic shocks. For the defensive investor, Graham wrote, "A strong financial structure is the bedrock upon which safety is built." When it came to bonds, Graham recommended focusing on high-grade issues, such as U.S. government securities or first-class corporate bonds. These bonds provided predictable income, lowered default risk, and an anchor for the portfolio during periods of stock market turbulence. He cautioned against the temptation to chase higher yields by taking on unnecessary risk with lower-rated debt. The purpose of bonds in a defensive portfolio was twofold: to provide a predictable income stream and to offer a stabilizing force when equities became volatile.
He warned against complexity and excessive trading. The defensive investor's goal was not to outperform the market in the short term, but to build wealth safely over decades. Buying companies of proven stability, holding high-quality bonds, and resisting the urge to react to daily market fluctuations were central to this philosophy. Finally, Graham highlighted the psychological comfort that comes from disciplined selection. Owning well-chosen stocks and bonds gave investors confidence to endure market downturns. In an era of speculative mania, he observed, many investors suffered not because of market mechanics, but because their portfolios were filled with overvalued or weak securities. A carefully selected defensive portfolio, by contrast, could weather turbulence with dignity. Next, we will examine Graham's practical rules for stock valuation, including his famous margin of safety, which transforms these selection criteria from theory into actionable decision-making. One of Benjamin Graham's most enduring lessons is the concept of the margin of safety. Though often associated with enterprising or value investors hunting for bargains, Graham believed that even the defensive investor should embrace this principle. The margin of safety is, at its core, a buffer, an investment purchased at a price significantly below its intrinsic value, offering protection against errors in judgment or unforeseen economic events. For defensive investors, the margin of safety was less about chasing deep discounts and more about disciplined valuation and caution. Graham urged investors to ask, "Am I paying more than this security is fundamentally worth?" He warned that overpaying, even for a strong company, erodes future returns and exposes the portfolio to unnecessary risk. In Graham's lifetime, examples of the margin of safety were plentiful. Consider the stock market boom of the 1920s, when exuberance led investors to pay astronomical prices relative to earnings. Companies with solid balance sheets and dividends were traded at valuations that ignored their actual earning power. Those who followed the crowd, ignoring intrinsic value, suffered catastrophic losses in the 1929 crash. In contrast, investors who waited for a reasonable price or who diversified with bonds and stable stocks were able to preserve capital and recover more quickly. How did a defensive investor implement this practically? Graham recommended simple screens. For stocks, he suggested purchasing companies whose price was below a multiple of average earnings over the previous 5 years, combined with a strong dividend history. This approach ensured that even if earnings fluctuated, the investor would not overpay. For bonds, the margin of safety could be built through careful selection of high-quality issues, paying attention not only to yield, but also to the issuer's ability to honor its obligations. Graham advised against high-yield speculative bonds, arguing that the extra income rarely compensated for the hidden risk of default. He also emphasized patience. The margin of safety is not a guarantee that a stock will rise immediately. Rather, it allows investors to withstand short-term volatility. In today's markets, this might translate to purchasing a solid dividend-paying company after a market correction rather than chasing the latest tech hype. Another key aspect of the margin of safety is recognition of one's own limitations. Graham frequently reminded investors that no one could predict the market with certainty. By purchasing securities at a discount to intrinsic value, the defensive investor gains a cushion against both market fluctuations and personal miscalculations. Perhaps most importantly, the margin of safety instills confidence. When investors know they have bought with prudence, they are less likely to panic during market downturns, a lesson vividly illustrated during the Great Depression. Many investors who overpaid or speculated heavily were forced to sell at devastating losses. Those who adhered to Graham's principles could hold their positions, avoid forced liquidation, and ultimately benefit from the market's eventual recovery. Next, we will explore the role of market psychology, including the famous Mr. Market metaphor, and how defensive investors can maintain composure when the market swings wildly.
Benjamin Graham had a remarkable way of personifying the market, turning an abstract concept into something every investor could relate to. He introduced the idea of Mr. Market, an imaginary business partner whose mood swings dictated the price of stocks. One day, Mr. Market would be euphoric, offering shares at prices far above their intrinsic value. The next, he would be despondent, willing to sell at a fraction of a stock's true worth. For the defensive investor, Graham's message was simple but profound. Do not let Mr. Market's emotions dictate your decisions. The market's volatility is not a reflection of your judgment or the fundamental value of your holdings. It is a reflection of collective sentiment, often irrational and sometimes dangerous. During the 1929 stock market crash, Mr. Market's pessimism reached a fever pitch. Prices plunged precipitously, sending panicked investors into a frenzy of selling. Many who had bought without considering intrinsic value or a margin of safety were wiped out. Graham observed that those who treated the market as a tool rather than a master were the ones who survived. They did not react to fear and greed, but instead assessed their investments based on fundamental worth. For the defensive investor, this meant cultivating patience and emotional discipline. Graham advised that when Mr. Market offers a bargain, consider buying. When he becomes irrationally enthusiastic, be prepared to wait or even sell if valuations are stretched. The key is not to follow the crowd blindly, but to use the market's mood swings as opportunities. In modern markets, this lesson remains as relevant as ever. Consider periods of tech mania, cryptocurrency booms, or sudden corrections. The emotional waves can tempt even experienced investors to act impulsively. Graham's framework encourages a measured response. Analyze, compare with intrinsic value, and decide based on fundamentals rather than sentiment. He also emphasized that defensive investors should maintain a diversified portfolio, a buffer against Mr. Market's extremes. Diversification is not just about spreading capital, it is a psychological shield. When one part of the portfolio underperforms due to market sentiment, gains in other areas help maintain confidence and prevent rash decisions. Moreover, he warned against herd behavior. People tend to buy what everyone else is buying and sell what everyone else is selling. For the defensive investor, this is often a recipe for disaster. By adhering to a disciplined approach grounded in valuation and risk assessment, an investor can remain calm amidst panic and avoid the costly mistakes of speculation. Another critical aspect of market psychology is the patience to accept that returns may come slowly. Graham reminded investors that the market does not always reward prudence immediately. The defensive investor might feel stagnant compared to those chasing fads or high-flying stocks, but the long-term outcome favors patience, discipline, and respect for fundamentals. Next, we will examine the final two steps in the defensive investor's checklist: diversification and balancing stocks versus bonds, illustrating how these choices preserve capital while providing steady growth over time. As we reach the final stages of Graham's defensive investor strategy, two interrelated concepts become central: diversification and asset allocation. While they may sound technical, their application is surprisingly straightforward and crucial for anyone seeking to preserve capital while earning reasonable returns. Graham's philosophy was that the defensive investor should avoid placing all eggs in one basket. This principle, diversification, serves a dual purpose. First, it reduces the risk that any single investment will devastate your portfolio. Second, it smooths out the inevitable ups and downs of the market, allowing your portfolio to grow steadily rather than swing wildly with sentiment. He advocated for a mix of common stocks and high-grade bonds. the exact proportions depending on market conditions and the investor's temperament. In the 1940s, Graham recommended that defensive investors maintain roughly equal weights, 50% in bonds and 50% in stocks, as a starting point, adjusting slightly depending on prevailing economic conditions. The key was never to let either component drop below 1/3 or exceed 2/3 of the portfolio.
This balanced approach ensures that during periods of stock market turmoil, bonds act as a stabilizer. Conversely, when interest rates are low and bond yields modest, stocks provide potential for growth. Graham warned against chasing the latest trends or attempting to time the market. He believed that defensive investors should focus on what is steady, reliable, and proven over decades of market history. Diversification within each asset class is equally important. For stocks, Graham recommended holding 10 to 30 carefully selected issues, preferably leaders in stable industries with strong financials and consistent dividends. The idea is not to chase high returns, but to minimize the risk of catastrophic loss. For bonds, he favored high-grade corporate bonds and government securities, emphasizing safety and predictable income. Speculative bonds, convertible issues, or low-quality junk bonds were considered inappropriate for the defensive investor, as they introduce unnecessary risk without proportional reward. To illustrate, let's imagine the market in the early 1930s, during the Great Depression. Investors who had concentrated portfolios of speculative stocks saw their wealth evaporate almost overnight. Those who held a diversified mix of strong companies and government bonds, however, experienced less dramatic losses and had the financial stability to capitalize on opportunities once the economy began to recover. In modern investing, Graham's principles translate into a diversified portfolio of well-established equities, perhaps across different sectors, paired with high-quality bonds. Today's defensive investor might hold index funds for broad stock market exposure and government or investment-grade corporate bonds for security. The exact ratio can be adjusted depending on age, financial goals, and risk tolerance, but the underlying principle remains timeless. Balance risk with reward and never place all faith in one investment. Another subtle point Graham made is the psychological comfort that diversification provides. When investors know their holdings are spread across multiple sectors and asset types, they are less likely to panic during market downturns. This peace of mind is not merely emotional. It directly supports better financial decision-making by preventing impulsive, fear-driven actions. Finally, Graham underscored the importance of reviewing and rebalancing the portfolio periodically. As stocks outperform bonds or vice versa, the original allocation shifts, potentially increasing risk beyond the investor's comfort level. By rebalancing, selling portions of the outperforming asset and adding to the underperforming one, the defensive investor maintains the intended risk profile, buys low, sells high in a disciplined manner, and avoids being swept away by market extremes. Next, we will bring together all of Graham's lessons for the defensive investor, showing how patience, discipline, valuation, and careful allocation combine into a timeless strategy that protects capital while enabling long-term wealth accumulation. As we approach the culmination of Graham's guidance, it becomes clear that his defensive investor strategy is less about chasing spectacular gains and more about building a fortress around your capital, one that allows wealth to grow steadily, securely, and with minimal stress. Let's take a step back and consider the journey we've traversed. We began by distinguishing between the defensive and enterprising investor,
emphasizing that most people should focus on the defensive path, a path defined by patience, discipline, and a respect for the inherent unpredictability of markets. We explored how valuation protects investors, why avoiding overpaying is crucial, and how a careful balance between stocks and bonds ensures both growth and safety. Now we integrate these lessons into a single, cohesive approach. Graham's blueprint for the defensive investor can be summarized in 4 intertwined principles. 1. Discipline in selection. Invest only in well-established, financially sound companies that pay consistent dividends. Avoid speculation, hot trends, or complex financial instruments that you cannot fully understand. 2. Margin of safety. Always pay less than what an investment is intrinsically worth. This buffer shields you from errors in judgment, market fluctuations, and unforeseen economic events.
3. Diversification. Spread investments across multiple companies and sectors, and balance stocks with high-grade bonds. Diversification is not just a protective measure, it also allows the investor to sleep peacefully through market storms. 4. Patience and rebalancing. Accept that markets will fluctuate. Resist the urge to react impulsively to short-term gains or losses. Periodically rebalance the portfolio to maintain your intended risk allocation, selling portions that have grown disproportionately and reinforcing those that remain undervalued. To illustrate the power of this integrated approach, imagine a defensive investor in the 1950s who heeded Graham's advice. Instead of chasing the hottest industrial stock or a speculative IPO, they held a diversified portfolio of 15 to 20 blue-chip stocks, balanced with 50% bonds. When the market experienced volatility, whether from recessionary pressures, geopolitical events, or the residual effects of the Depression, they didn't panic. Their portfolio might have grown slowly, but steadily, and they retained the ability to capitalize on new opportunities when they arose. Fast forward to today. The same principles apply. Modern defensive investors might use low-cost index funds to achieve diversification across hundreds of companies, paired with government or investment-grade corporate bonds. The numbers have changed, the technology has evolved, but the essence remains: discipline, valuation, diversification, and patience. One of Graham's most striking insights is that success in investing is more about temperament than intellect. You don't need to predict the next economic boom or pick the next star company. You need to cultivate patience, stick to a rational process, and remain emotionally steady when the market swings. Graham often emphasized that it is far better to be approximately right than precisely wrong, meaning that a consistent, reasonable approach will outperform risky, overconfident speculation over decades. Consider, too, the role of psychology. Market hysteria and euphoria often tempt investors to abandon their principles. Defensive investors, grounded in Graham's strategy, are shielded from this collective frenzy. They do not seek to outsmart the market daily. Instead, they follow a proven process that withstands both bull and bear markets. Finally, Graham's defensive investor is not passive in the sense of ignorance. Knowledge, research, and a clear understanding of each investment are vital. Yet this knowledge is applied with restraint, not impulsive enthusiasm. The goal is preservation and steady growth, not short-term heroism. As we conclude this penultimate segment, it's essential to remember that Graham's strategy is timeless precisely because it addresses both the financial and psychological dimensions of investing. It teaches us to respect uncertainty, manage risk thoughtfully, and cultivate patience, a combination that few speculative strategies can match. Now we arrive at the moment where theory meets practice. After exploring Graham's timeless principles, analyzing historical examples, and reflecting on investor psychology, the question becomes, how do you, sitting here today, build a defensive portfolio that can withstand market storms while steadily growing your wealth? Lesson 1. Establish clear objectives. Before buying a single share, define your goals. Are you investing primarily for retirement, preserving capital, or generating a reliable income stream? Graham stressed that every investment decision must be guided by your personal financial objectives. Without clarity, Even the most prudent strategy can falter. Lesson 2. Allocate between stocks and bonds. Graham recommended a simple, flexible approach. Maintain a balance between high-quality stocks and investment-grade bonds. In his era, this often meant a 50-50 split, adjusted slightly according to market conditions. Today, a defensive investor might hold a mix of broad market index funds and government or top-rated corporate bonds. The exact ratio can fluctuate, but the principle is constant. Diversification across asset classes reduces risk and smooths returns. Lesson 3. Focus on value, not price movements. Resist the temptation to chase the latest hot stock or jump on market momentum. Graham's insistence on intrinsic value remains critical. Evaluate companies based on their earnings, dividends, and financial strength. Pay less than the estimated intrinsic value to create a margin of safety. Remember, the market's daily fluctuations are noise. What matters is the underlying value.
Lesson 4. Diversify, but thoughtfully. Diversification is not about holding 100 stocks indiscriminately. It's about carefully selecting a range of well-analyzed companies across different sectors. Similarly, diversify your bond holdings to include both short and long-term instruments, or government and corporate bonds. Thoughtful diversification reduces the risk of a single failure derailing your portfolio. Lesson 5. Practice patience and discipline. Perhaps Graham's most repeated advice was patience. Avoid reacting emotionally to short-term market swings. A defensive investor views volatility as an opportunity, not a threat. When stocks fall below intrinsic value, disciplined investors may add selectively. When they rise above, they may trim positions to maintain balance. Lesson 6. Rebalance periodically. Markets do not remain static. Over time, stocks may grow faster than bonds, or vice versa, skewing your intended allocation. Rebalancing ensures you maintain your risk profile, selling portions that have outperformed and reinforcing those that remain undervalued. This disciplined approach enforces the margin of safety across the entire portfolio. Lesson 7. Limit speculation. Even today, the allure of speculative instruments, options, cryptocurrencies, leveraged ETFs, tempts many investors. Graham warned against speculation disguised as investing. Defensive investors avoid high-risk vehicles unless they fully understand the mechanics and potential downside. Protecting capital is always the first priority. Lesson 8. Maintain emotional equanimity. Markets will inevitably present fear and greed in dramatic doses. Defensive investors must cultivate a mindset that views market swings with calm detachment. Graham often likened investors to long-term partners in a business, not gamblers chasing short-term thrills. By controlling your emotional responses, you avoid impulsive decisions that erode wealth. Lesson 9. Focus on the long-term horizon. The defensive investor's journey is measured in decades, not months. Graham's own students, most famously Warren Buffett, demonstrated how long-term adherence to fundamental principles leads to compounding success. Today's defensive investors must embrace the same long horizon, resisting the lure of frequent trading or market timing. Lesson 10. Continuous learning and adaptation. Finally, Graham recognized that markets evolve. While the core principles remain constant, investors should continue learning, staying informed about economic trends, corporate fundamentals, and changes in financial regulations. Knowledge enhances decision-making, but must be applied within the disciplined framework of defensive investing. To bring all these lessons together, imagine a modern defensive investor named Sarah. She begins with a clear goal: secure retirement at age 65 with minimal stress. She allocates 60% to diversified, dividend-paying stocks and 40% to high-quality bonds. Every quarter, she reviews her portfolio, rebalancing to maintain these ratios. She resists the temptation to follow market hype, focuses on intrinsic value, and adjusts slowly as her life circumstances change.
Over 20 years, her wealth grows steadily, providing financial security and peace of mind, exactly as Graham intended. In essence, the defensive investor's path is not flashy, nor does it promise extraordinary overnight gains, but it does offer something far more valuable: the power to preserve and grow wealth predictably, safely, and sustainably. It's a strategy rooted in rationality, patience, and a profound respect for the unpredictable nature of markets. And so we conclude our journey through Graham's defensive investor philosophy. The wisdom he imparted in the 1940s remains fully relevant today. By following his principles, avoiding overpayment, diversifying intelligently, maintaining discipline, and exercising patience, any investor can navigate the modern markets with confidence. The final takeaway is simple. Success in investing is not about outsmarting the market. It's about respecting its power, protecting your capital, and making thoughtful, measured decisions. This is the timeless promise of Benjamin Graham's defensive strategy, a promise that continues to guide prudent investors across generations. With these lessons in hand, you are equipped to approach your portfolio not as a series of guesses or bets, but as a carefully structured, resilient engine for wealth creation. Graham's guidance remains your compass, the market your testing ground, and your discipline the key to enduring success.